Good morning and welcome to webinar number 12, 2020 year-end tax planning. It's a little colder here relatively colder here in Charleston this morning. Patrick and I have been in a little bit of a battle with the thermostat. My office is cold, he's warm. I think it's because he has the 4 layers and like a 3-piece suit on over there in the office next to me.
We've established that my tie doesn't count as a layer.
But yeah, so Patrick's here, of course. Gonna help with some technology and.
Yeah, if anyone has any issues, I got my email open on another screen here. So just shoot an email to info@oceansideadvisors.com. If you can't hear us or not popping up on your screen, whatever the problem might be, happy to help.
Perfect. So this is webinar number 12. It's amazing. We've been through a dozen of these now. It was actually my mom's idea. I'm not sure if she's on the webinar or not, but so thanks, Mom, if you are. But so this is going to be our last webinar of the 2020 season, and just hoping to spend a little bit more time with some family between now and the end of the year, and of course we're going to be really busy working on a lot of what we're going to be going over today. So it's always end of the year is always pretty busy for us, and of course trying to make some quality time with family. So but we certainly appreciate you joining us and coming along for this journey this webinar journey over the last 12 or so topics. So we really appreciate it. This is one of our favorite topics, year-end, well, just tax planning in general, but so we're happy that you can join us today. All right, so as always, through this webinar, Oceanside Advisors does not offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. So obviously, we always encourage you to work very closely with your CPAs on things like this, and that's of course why we work very closely with CPAs. We share an office with CPA group. There's always things that can be specific to your situation that you want to be careful with. So, all right. So our goals for today. All right. So we want to understand some tax planning strategies available for individuals in 2020. Of course, we could present a whole nother webinar on business tax planning for 2020, but given the majority of the people we help, it's some of them business owners, but it's a lot of individuals, a lot of people coming into retirement, in retirement already, and we felt this topic was most applicable. So the first thing we're going to do is just a crash course on how my taxes are calculated. I thought we needed to do that just because a lot of the material that we're going to be going over, if you don't know the basics of how taxes are calculated anyway, a lot of this isn't going to make sense. So we're going to do a 1-slide crash course, of course, an extremely simplified explanation of how taxes are calculated. And then once we get through that slide, we are going to move on to some some specific tax items for 2020, some of which came through the CARES Act, the Coronavirus Relief Act that Congress passed a few months back. We will then be looking at how I can reduce my taxable income between now and the end of the year. And the last thing we're going to do is how can I increase my taxable income this year? And if you are new to retirement tax planning, you might look at that last one and be like, what in the world are you talking about? Why would I ever want to increase my taxable income in any year? but we're going to give you a couple reasons why that might be in your best interest. Okay, so how are my taxes actually calculated? So this is my attempt, my one slide attempt to tax preparation kind of 101, the way it works. Okay, so basically you're going to start off with your gross income. All right, so what's gross income? That's, you know, if you're working, that's a W-2, 1099 if you're an independent contractor, Social Security, pensions. If you are self-employed, this is where like your Schedule C or K-1s will come through. All right, so there's a lot of different things that are going to be included in gross income. After you have your gross income, we're going to subtract deductions for AGI. Okay, deductions for adjusted gross income. Sometimes these are referred to as above the line deductions. All right, so these are going to be things like IRA contributions, health savings account contributions, student loan interest if you're below certain thresholds, moving expenses. There's a handful of them, but these are your above the line deductions. So gross income minus these deductions for AGI is going to give us what's referred to as adjusted gross income. All right, I put some stars by this because this is a really important line item. Between adjusted gross income and something called modified adjusted gross income, which is just a slight deviation of this, where they're going to include some capital gains and add back some above the line items. This adjusted gross income is going to determine, you know, things like, do I qualify for certain tax credits? You know, can I contribute to a Roth? Are my traditional IRA contributions truly deductible? Medical deductions, you know, a percentage of AGI. So a very important figure here is this adjusted gross income for tax planning. All right, and then once we have your adjusted gross income, here's where we start to get a little more complex that I think a lot of people don't quite understand. Adjusted gross income, the next step, we're going to subtract a standard deduction or an itemized deduction. So you don't get to do both. You're going to end up claiming whichever one is higher, right? So standard deduction or itemized deduction. So what are these? Well, in 2020, if you are single, the standard deduction is $12,400. If you are married filing jointly, the standard deduction is $24,800. And then once you reach the age of 65, they also give you this additional $1,300 standard deduction. So again, so $2,600 that would mean for a couple that's older than 65. So, you know, between all of this, you know, a couple that's, you know, 66 years old is going to have a standard deduction of $27,400. So a big number. And then the other side, so, or itemized deductions, right? So itemized deductions are going to be the sum of, these are the four main ones. All right, so any kind of mortgage interest that you might have, medical expenses that exceed 10% of your adjusted gross income, state and local taxes, and this is now capped at $10,000 since the Tax Cuts and Jobs Act, and then any kind of charitable contributions that you might have. All right, so, you know, to put this in perspective, like, you know, remember, you only get to do one or the other. So that's why many people are on this side, right? Because you need a lot of itemized deductions to exceed, you know, $27,400 over here. All right, so after you take off your either the standard deduction or the itemized deduction, this is what gives us the line item on your tax return that's called taxable income. All right, so from there you take taxable income and you're going to go to the schedule that shows the amount of tax that you would owe given that taxable income figure. You're not done yet. It's a crash course. We're really throwing at this everything at you pretty fast. But taxable income, now you're going to subtract any eligible tax credits that you're able to take. So these are going to be things like child tax credits, you know, solar credits, child dependent care credits. You know, if you're taking care of an elderly mom or dad, you might be able to qualify for a credit, right? So you get to subtract those, and after subtracting your tax credits, at that point you determine if, did I withhold enough money throughout the year? Do I need to send in a check, or am I receiving a refund? So again, this is a one-page slide, obviously extremely simplified, but hopefully, yeah, I'm guessing there might be a viewer or two that didn't exactly know the way taxes work. So I hope this slide was somewhat helpful. Right. And now the way federal tax brackets work, right? So here in the U.S., we have a progressive tax system where we prefer to look at it like instead of a lot of times you see tax brackets in like a chart. I think visually it's easier to conceptually see in something like this, where of course 0, 12%, 10%, 12%, and you can kind of see as your income increases on the x-axis, you're going to pay more in taxes. So this is for ordinary income 2020. This is a tax map for capital gains. All right, so capital gains and qualified dividends tax map for 2020. So same idea, but obviously much different. With capital gains, you have a 0% window, then it jumps up to 15% for many people, very wide income range here, and then from there it jumps up to 20%. Small little caveat, right kind of here in the middle, there's actually the net investment income tax, the Obamacare tax. It's about 3.8%, also jumps in right here, but we'll touch on that in a little bit. All right, so with kind of some of the basics in place, here are some specific items for 2020. All right, so required minimum distributions are not required for 2020. And this includes inherited IRAs. It's funny, we've just in the last week, we've received a couple of calls from people that still are not aware of this. All right, so asking about, do we need to take money out of the IRA this year? The answer to that is no. Okay, so with the CARES Act, there are no required minimum distributions required for 2020, and that includes any inherited IRAs. All right, the next item that I think a lot of people are overlooking is another part of the CARES Act is this $300 above the line charitable deduction that you can take. All right, so I'm just gonna go backwards really fast, back to our tax slide. Here we go, right here. So remember, historically speaking, charitable contributions are over here in itemized deductions. Okay, but for 2020 in the CARES Act, they said, given I think a lot of these charities, the government wanted to incentivize more people to give. And so what they said, okay, actually, we're going to put way up here an above the line item for even people that are claiming the standard deduction. Your first $300 to a qualified charity, you actually get to deduct it up here. Okay, so that's an above the line deduction, $300 to any kind of qualified charity. So keep that in mind, because that's going to be an easy one for a lot of people to forget come tax time. Right. Okay, yep, so again, even if you're taking the standard deduction like most people do, remember to tell your CPA or who's ever preparing your taxes to put that item in for you. All right, another specific item for 2020. Typically, if you have not yet reached the age of 59 and a half, in most retirement accounts, there's a 10% penalty for withdrawing money out of those accounts. This 10% premature withdrawal penalty has been waived on retirement accounts for coronavirus-related distributions. All right, so if you can make the argument that I made less money this year, I lost my job, my spouse lost their job, it's a pretty broad definition, and you feel you need some money out of your IRAs, that this is that they have waived that 10% penalty. So transitioning to why might I want to reduce my taxable income in 2020? So these are a lot of the ones that we're looking at when we are helping the people that we serve. One is I want to pay less for my Medicare Part B and Part D premiums. So there are certain breakpoints in the tax brackets called IRMA, which are these surcharges depending upon where your income falls, where if you can reduce your income, sometimes you can get below levels where it might, in some cases, it can make your Medicare, a couple $1,000s less that you're paying in Part B and Part D premiums, right? So we have these little tax maps, and if you're a client, these will look pretty familiar. But for example, if you were on this tax map, this spike, not surprisingly, right here is an IRMA threshold. So, if you're a couple $1,000s above this spike, we can do some of what we're going to go over on the next slide to get you on the left side of this spike and hopefully save you a couple $1,000. All right, so that's one reason you might want to reduce your taxable income. Another reason to receive a subsidy for Affordable Care Act insurance. Right, so we have some people that fall in this camp. I actually just built a financial plan for a new client last week where they had made really nice money, well into the six figures per year, and then they retired. So now you have no earned income, but yet they're 62, so you're not Medicare yet. Now, the way the Affordable Care Act works, insurance can be really, really expensive when you're from the age 62 to 64, right? And so the way it works, the way your premiums work, it's highly dependent on what your income is. So if we can find ways to reduce income a lot in those later years, right before Medicare starts, you can save a lot of money with proper tax planning with the Affordable Care Act. Pay less tax on my Social Security income. The way Social Security is taxed is very complicated. If you enjoy our webinars, you can always go back and watch, I believe there's webinar number 3, taxes in retirement. And there we kind of outline the formula for how Social Security is taxed. But a big part of it is, what is your other taxable income? So one way to pay less tax on your Social Security is to reduce your other forms of income. All right. A lot of times we see we need to reduce taxable income in order to have the ability to contribute to something like a Roth IRA. Okay, so married filing jointly, I'm just going off the top of my head right now, Patrick, you can correct me. I think it's somewhere around 196,000 in joint. I think that's modified adjusted gross income. So in other words, that's where the phase out starts. So if we can contribute to IRAs, or 401ks, other things to get income lower, it might allow you to contribute to a Roth IRA. Same idea, having the ability to deduct a traditional IRA contribution is going to be based on your taxable income. I alluded to it a little bit earlier, but that this 3.8% net investment income tax, this is the additional tax that they're using to fund the Obamacare. So if you can reduce some of your other income, you might be able to avoid that tax. And then the obvious one, reduce taxable income. You want to pay less in taxes this year, right? Like that's reducing your federal income is going to reduce what you have to pay in taxes. Okay. All right. So what are some things that I can do to reduce my taxable income? Just need a cup of sip of my coffee. It's still freezing in here, Patrick.
You nailed it, by the way. The phase out does start at 196 and ends at 206. So
oh, perfect. Thank you.
Good work.
Oh, thanks. Okay, so how do we reduce taxable income. What are some things that we can do to reduce taxable income? The obvious one, contribute to retirement plans. So if you're employed, you have earned income, you can make sure you're contributing as much as the IRS allows you to in 401ks, 403bs, 457s, traditional IRAs, SEP IRAs, just to name a couple of them. Contribute to health savings accounts. All right, so you're allowed to do that if you're on a high deductible health plan. You also have to be, once you reach Medicare, you're not allowed to contribute to HSAs any longer. But another great way to, if you're the one contributing to it, it's deductible. I know some employers offer these. If they are contributing to it, obviously that's not deductible to you. But a lot of times we see that employers will, contribute a couple thousand, and then, maybe you can make up the difference, and at least you have your part deductible. So something to consider there. Okay, contribute to 529 plans for kids or grandkids. Now this is not federal tax deductible, but most states you receive a state income tax deduction, and of course we're here in South Carolina, so here in South Carolina you do receive a state income tax deduction. I know we have a lot of viewers in other states, so certainly you're going to want to look up the rules for your specific state. Another strategy to reduce taxable income, you can tax loss harvest your taxable accounts. More on this later. It's actually going to be the next slide. You can also reduce your taxable income by bunching your itemized deductions. Okay, so we're also going to dedicate a slide to this later. And the last slide that we're going to go over in terms of ways to reduce taxable income are using qualified charitable distributions from retirement accounts. All right, so these are some different things to consider to reduce your taxable income for 2020. All right, so first we're going to start with tax loss harvesting. I think some people have a hard time grasping this idea. Now, the best time to do this, which we were doing in terms of tax loss harvesting losses, is when the market's declining, right? So for our clients, we were recognizing a lot of losses, back in March, April, when the market was in free fall. So the way it works, taxpayers can deduct up to $3,000 a year in capital losses in their non-qualified accounts. So you have to realize the loss. In other words, that means you actually have to sell the loser. So if you're looking at a taxable and non-qualified account, and you pull up a tab, like most custodians, you can pull it up right on the website, where you'll have what's called realized losses. So this means positions that you have already sold for a loss or sold for a gain, right? So you have realized gain loss, and then you'll have unrealized gain loss, right? So that means these are the existing positions that you own, and they're either going to be up or down, right? So just a very hypothetical example that I put together here. Let's say you sign into your account, and I just made up some random letters here. So let's say you have some different funds here, and then you're going to have a column that says unrealized gain loss. Well, let's just assume that this individual had not yet sold anything in their account for the tax year. It looks like they have a portfolio that's pretty diversified, right? So likely positions aren't all going to be moving in the same direction at once. So it's not uncommon to have a position that's down, right? So in this case, we would look at this individual. Anyone can see there's a pretty glaring difference here. Okay, so ticker IJDX is having a tough time this year. It's currently down $3,590. So what we would do, this would be a strong candidate where we could sell this position In other words, realize that loss, recognize the loss. And then kind of step two is, we don't want to be timing the market. So we want that the proceeds of the cash, we want that to be reinvested, right? So not only are we going to sell the position, but we want to go and buy a new position. However, a big caveat here, you cannot buy an identical security, right? So, and this is a mistake that I think some retail investors make. Yeah, you can't sell IJDX and say, great, I realized this loss for $3,500. Now I'm going to buy it back the next day. That does not work. That's called a wash sale, which means your write-off is going to be disqualified. Okay, so it's not just identical, but there's also some gray area that you probably don't want to test. For example, let's say IJDX is a Vanguard S&P 500 fund, okay, and it's down. You probably don't want to sell the Vanguard S&P 500 fund and then use the proceeds and go and buy like a BlackRock S&P 500 fund, because those are basically going to be the same holdings. You could potentially get yourself in some trouble there. So just, I wanted to point out, after you sell the position, to harvest that loss, realize that loss for your taxes this year. And then you probably want to find something new to buy. Just make sure it's not identical. All right. So what happens if we do this the right way? All right. We sell IJDX. Again, we have about a $3,500 loss here. So this taxpayer is going to receive a $3,000 above the line deduction for 2020. And then what happens is that additional $590.09 that we were not able to deduct for this year, that's just going to carry over into 2021, right? So you're going to find that on Schedule D. All right, and another strategy to reduce income, and this is more a multi-year strategy, but just this concept of bunching itemized deductions. All right, so given the increased standard deduction from the Tax Cuts and Jobs Act back in 2017, but before standard deductions were only about half of what they are today. Right. So given now they're way up, the example we showed, if you're older than 65, you and a spouse, your standard deduction is going to be $27,400. So given that fact, it's estimated only 12% of taxpayers now claim itemized deductions. So almost 90% are taking the standard deduction. Okay, so one thing to consider. All right, so just a hypothetical example. So here, of course, are the main 4 itemized deductions that you most commonly see. So let's say this individual has mortgage interest of $10,000, property taxes. Now, if you're outside of South Carolina, you're probably laughing at this. Property taxes of $3,000. I know we have some viewers up north, but yeah, $3,000. Approximately a $500,000 or $600,000 house is probably going to pay only $3,000 in property taxes here in South Carolina. So $3,000 in property taxes. Let's just say you're not expecting anything tough medically, so you're not going to have any medical expenses in excess of 10% AGI. So we have a 0 there. And then let's say you give to your church or synagogue or whatever charity is meaningful to you. Let's say you typically give $12,000 to that organization. All right, so this individual currently has itemized deductions in total of $25,000. Now, the problem with that is, again, assuming that this is a married couple older than 65 years old, that amount's not higher than the standard deduction, right? So you have $27,400 standard deduction. So every year, they're going to be taking the standard deduction, and they're not truly getting a deduction on anything here. Okay, so then you have this concept of what if we bunched some deductions into 1 year instead? All right, so what do I mean by this? Let's start over. All right, so mortgage interest, that's just going to be the same. The mortgage company, they're not going to let you prepay interest, anything like that. So the following year, this is going to be the same. But now property taxes, at times you can get a little bit creative with. So for example, like here in South Carolina, maybe a month ago, in October, like I received my property tax bill in the mail. Okay, and then now the property tax bill here in South Carolina is due January 15th. Okay, it's due January 15th of 2021. So what you can actually do with property taxes, I already paid mine, but what you could do, you could hold that bill and wait until after January 1st, and you could pay that property tax bill after January, because again, it's not due till January 15th, right? So that's $3,000. And then, next fall, you could get the bill for the following year, and then you could pay it in the same year. So in other words, you could bunch your property taxes $6,000 into 1 year, and then therefore the following year, really, you wouldn't have a property tax bill, right? So, and now same concept with like charitable contributions. If you have the ability to do it, let's say, tithing is really important to you, and you're gonna give $12,000 a year. Well, what if instead you said, okay, I know I'm giving $12,000 a year, but I'm gonna do $24,000 instead this year, and then the following year I'm not gonna give anything. And so $24,000 this year, next year I'm not gonna give anything. Effectively, you're doing the same thing. You're giving the organization the money up front, which that they probably would prefer that anyway, right? So instead, what this is going to look like in this case, right? So let's pay 2 years worth of property taxes and 2 years worth of charitable contributions in a single year, and then 0 the following year for both, right? So this chart, it's going to change. It's going to look like this, right? So we still have $10,000 mortgage interest. Now we have $6,000 in property taxes. We have $24,000 in charitable contributions. Well, now this changes the story, right? So now we have total itemized deductions of $40,000. This works out pretty well because now we are, even though you have not paid $1 more in any of these expenses over these 2 years, now you get to take the itemized deduction. You have $13,000 more of tax write-offs, right? So that's wonderful. So the first year you're going to take the itemized deduction, $40,000. Now think forward to the year after that. Charitable contributions are going to be 0. Property taxes are going to be 0. So the only itemized deductions you're going to have the following year are going to be the mortgage interest of $10,000. But that's okay because you're just taking the standard deduction anyway that the following year. So you're just back to the $27,400. So this is a pretty simple example. At the same time, this can be a huge benefit, especially if you find yourself in the situation where, like this example, you're just slightly below the standard deduction. If you look on your Schedule A, which is where your itemized deductions are, and if you look on it and you notice you're just like a couple $1,000s every year below what the standard deduction is, this is something that you should look into more carefully, because if you do it right, it is legal to do. This could save you a lot of money on taxes. Okay, the next item is something we call qualified charitable distributions. All right, so qualified charitable distributions, if you're older than 70 and a half years old, this can be a wonderful tax planning tool. Now, I will say that the qualified charitable distributions are more useful in years where they require a required minimum distribution. All right, so it's a little bit, we still have clients doing it this year, but it loses some of its advantages. So looking out at 2021, assuming that they require distributions, this will be something to look at again. But the way qualified charitable distributions work, All right, so you give funds to charity directly from your IRA to that charity. And you see down here, I have like, you can't touch it. Like I should have made that bold or underlined or in a larger font. Like you literally can't touch it for it to qualify. So what I mean by that is you can't like withdraw money from your IRA, you get the check and then you give it to the charity. That would be disqualified. You wouldn't get the tax break. So what this means is you contact your, so who's ever holding your assets, right? So we do this for a number of clients where they call us, they say, you know, this is the address, this is the organization. I want to make qualified charitable distributions to wherever it is, you know, this church, this whatever is important to, so, you know, all kinds, we see all kinds of things, right? So, and what that means, so we set it up where TD Ameritrade or Charles Schwab, they're going to send a specific amount from your account that you sign off on. They're going to send the check directly from them to that charity. Okay, so again, you can't touch it. The check has to go directly from your account straight to that charity. Okay, so if it qualifies, what's wonderful is qualified charitable distributions count toward your required minimum distribution, right? So if your required minimum distribution is $20,000 and you want to give it all to charity, you could make the whole $20,000 a qualified charitable distribution, and you could write the whole thing to that charity. Now, what's nice about this is that qualified charitable distribution, it's not included in your gross income if you do it that way, right? So in other words, if you just take the required minimum distribution on your own to your own account, that's going to get reported as taxable income. If you send it right to the charity, then it's not, right? So it's not included in your gross income. So really what you're doing here, you can kill two birds with one stone. You can satisfy the requirements for the distribution as well as be charitable, right? So qualified charitable distributions are a wonderful way to be charitable, especially if you're claiming the standard deduction, right? So kind of back to a couple slides earlier, if your itemized deductions, you can just never get them above that threshold, even if you're bunching them, right? So if it's just a level where you're significantly below the standard, if you're significantly below the standard deduction amount, this is a great way to be charitable and you're effectively getting the same deduction. But going back to, you can't do this until you're 70 and a half. So what's nice though is when they changed the RMD rules from, it used to be 70 and a half to, now it's up to 72, and there's even talk they might change it to 75. They kept the qualified charitable distributions at 70 and a half. So that's when you can begin doing those. Last point on QCDs, the charity must be a 501c3 organization, and even within 501s, like some will not qualify, right? So you just, like, for example, like private foundations aren't going to qualify. So whatever the organization might be, the vast majority of them do qualify, but that's something you want to double check before you start cutting checks to them. Okay, why might I want to increase my taxable income in 2020? And this is the one that, if you don't have a lot of experience with tax planning, might seem a little counterintuitive. But so the basic premise is, if you think you're in a lower tax bracket this year than you will be in future years, you might want to consider doing something, right? So what a lot of people don't consider is, that especially if you have a large IRA, where you're staring down the barrel of some required minimum distributions that only get bigger and bigger as you get older and older, and Social Security, of course, is increasing. What a lot of times you want to recognize a little bit more taxable income today, and therefore, theoretically, avoid paying higher taxes later. So that's kind of the idea. Now, we use a lot of software to help kind of identify when this might be the case. So I know this is going to probably be hard for you to see on your computers, but this, for example, is just a piece of software that we use where we'll plug in someone's IRA balances and their Social Security benefits and pensions, things like that, and we'll get a rough estimate of, like, so the y-axis here is these are tax rates. The purple is federal, expected federal tax rates. The blue is more state tax, what we think are going to be state tax liabilities. And then the bottom, it just kind of shows, like, as you get older, right? So here's 70s, 80s, 90s. Right? So, and this is very common, where a lot of times you retire, you're not taking distributions yet. You might be in a 10, 12% federal bracket. And what happens, required minimum distributions start, and all of a sudden you're in a significantly higher tax bracket while you're taking out a lot more, which can end up, in the long run, you can end up paying far more in taxes. So it's just, it's really nice having the software where we can, for example, like this, we can project what we think someone's taxes are going to look like in 2033, or any year we pick. So it's really nice. So when I was preparing for this webinar, I'm looking at this map. It's like, how do we kind of describe, like, what you're trying to do? And I was trying to think of a better way to say it, especially with how many times you've all heard this phrase, but really what you're trying to do is, like, flatten the curve. I didn't want to say that, but essentially that's what we're trying to do with your effective tax rate. So what you would rather see is a little bit more taxes in the front here, and that way your IRA's balance are smaller later in retirement, and then so you're a little bit lower later on. Ends up, most of the time, you end up having more money in your pocket. Okay. However, warning, and this is really important, that there are some huge things to consider before you start finding ways to increase your taxable income. Okay. And this is always why we encourage you to work with CPAs and other tax professionals, because by realizing more income, it can trigger a lot of other things that you need to be careful with. For example, is increasing my income going to make my Social Security taxed at a higher rate, right? So Social Security, like, it's taxed a little bit differently, where, for some people this year, for example, without RMDs, they're in a spot where they're paying almost zero taxes. And even, like, their income's so low that their Social Security is taxed at zero, where, you look at a tax map like this and it's like, oh, we should probably be doing some Roth conversions. But then you look at it, and if you start increasing income, that not only are you paying taxes on that additional income, but all of a sudden your Social Security, maybe your full Social Security, starts to get taxed again, right? So your effective rate could be significantly higher by making that, by increasing your income or making a conversion, which we'll get into in just a minute. So you want to be very cognizant, like, would this increase my Social Security taxation? We touched on it earlier, but now on the opposite side, like, would I lose my Obamacare, my Affordable Care Act subsidy? Is it going to push me past a Medicare IRMA threshold, right, where now my Medicare is going to become more expensive? Is this going to push me into that net investment income tax, the 3.8%? Right. So all, like, huge considerations that need to be considered before proactively doing some tax planning like this. Okay, so one way to increase your income, which may be in your best interest after careful analysis, something called Roth conversions. So the way this works is you convert. It just means transfer a calculated amount of money from your traditional IRA over to your Roth IRA. And I put here ideally before RMD age, just because Many of the times, like that's the period of time where we find people in the lowest tax brackets, right? So you work your whole life. Of course, you're earning money, so you're in a higher tax bracket. All of a sudden, you stop working, you retire, and many times there's like this window where you no longer have earned income. Maybe you started your Social Security, maybe you didn't, but you haven't been forced to take required minimum distributions yet, right? So you're almost in like this artificially low tax bracket. Many times this is the best time to be making conversions. Now, with that being said, we still convert a lot of money for people that have already reached RMD age, and so with that, they take their required distribution, and then on top of that, if we still think their taxes might be higher tomorrow than they are today, we might still be converting a little bit there as well. Right. So again, just the simple idea: pay the taxes this year at a lower rate. If you think taxes are going to be higher in a future year for you because of maybe you think the government's going to raise taxes, maybe if you have a large IRA balance, I can promise you it's almost certain your taxes will be higher later. So that's just what you need to take, those inputs that you need for the analysis. Right. So conversions are going to reduce the balance of your traditional IRA, thus lowering future RMD amounts, which at that point would be taxable. All right, once money's over in your Roth IRA, it enjoys a lot of benefits. So, tax-free interest, tax-free dividends, tax-free growth, tax-free withdrawals, right? So in your lifetime, there's no required minimum distributions for Roth IRAs. So it's wonderful money. It's really nice. It gives your retirement plan a great deal of flexibility if you can have Roth IRA money, traditional IRA money, and non-qualified money. If you have all three buckets, it gives a great deal of tax planning flexibility. We love it when we see that, and a lot, especially when we start working with people early in retirement, it's something that we try to work towards if it makes sense. So a lot of times people won't have a Roth yet when they come into retirement, and then we use those years early in retirement to start building it up. So you do have that flexibility later in retirement. Again, please consult with your financial and your tax professional before completing Roth conversions. I just think it's really important. And I just want to be really careful in such a broad platform here, such as a webinar, that you really need to be careful when you're looking into these things. Okay, another form of increasing your taxable income is harvesting long-term capital gains. All right, so if you recall earlier in the webinar, we discussed harvesting losses, right? So if you're trying to reduce your taxable income, you can sell some losses and you can get $3,000 as a write-off. Well, on the other side, if you recall from the very beginning of the webinar, there's a little pocket where there's actually there's a 0% capital gain rate. All right, so many investors aren't aware of this. It's a 0% tax rate window for long-term capital gains down here. Now, in practice, it's far more complex than this, because the way it works is they stack your ordinary income in here first, and then if there's still room left for long-term capital gains, that's where you can start filling like whatever is left in this 0% tax window. So like in our practice, this is kind of the last step that we're looking to do for clients between now and the end of the year. So, for the most part, we've already completed the Roth conversions that we want to complete. We've already done the tax loss harvest for losses, right? When the market was crashing, when the market was much lower. And so at the end of the year, this is what I'm going to be, myself and Patrick and Tyson, we're going to be spending a lot of our time doing this analysis for clients between now and the end of the year, just looking, especially without required minimum distributions, right? So we're going to have some clients that have much lower income than they typically do, and if there's room to recognize capital gains at a 0% tax window, there's probably going to be a lot of opportunity this year. So I should just click before I talk, but so exactly that. If you experience a year of lower than typical ordinary income, you may want to consider harvesting positions in non-qualified accounts that have long-term capital gains. And then again, I know I keep putting these here. Last warning, I promise, I say here, recognizing long-term capital gains can also push modified adjusted gross income levels over thresholds. You can run into the same problems, increasing insurance premiums, taxes. So again, you want to be really careful here. All right. This is fun. I'm such a nerd for this stuff. All right. So just one quick slide here. Yeah, I realize we have a lot of viewers here that are already working with us, and you're probably familiar with a lot of these concepts already. We also have many viewers on here that don't work with us on a full-time basis. And you know, we always put this offer out here. You know, we have some really helpful software where we would be happy to just punch in a tax return, an expected tax return, complimentary, you know, one of our advisors. We'd be glad to do that free of charge. And if you want to engage us after that, wonderful. If not, like, no hard feelings. We'll shake hands, walk away friends. Well, maybe not shake hands this year, but you know, we'll walk away friends. And we love, you know, being able to help, you know, helping people and putting out educational material. So yeah, again, just, you know, some of the software that we use, if this is something that you'd be interested to know where you sit, you know, on a year-to-year basis like this, or more a long-term projection, you know, this is something that you know, myself or one of our advisors, we can put together what we call an initial case analysis and give you a couple suggestions. So with that, I hope we found this helpful, not overwhelming. Taxes are hard. And so I think we will open it up for some questions.
Yeah, I thought that was good. You might notice I'm now standing. I've been slugging coffee the whole webinar, and I'm all fired up here for the questions. We had two good ones come in yesterday, actually, from Doug, a couple heavy hitters. When an RMD is taken, will it be subject to immediate state and federal withholdings tax, even though the taxes are not due until April 15th of the next year? The RMD is taken mid-year. Will the withholding tax be paid to the government at that time, or can the withheld taxes remain as investments until due on April 15th? So this is the easier of the two questions Doug sent us. Withholdings are fired out right away. You can't keep them invested as much as we'd like to. Even though they're not due until April 15th, the fact that you're withholding that money is important for your, to avoid paying penalties in not withholding enough taxes. You know, if you're making quarterly tax estimates, which is kind of what your next question leads into. When a Roth conversion is made from a qualified retirement investment and no tax withholding is withheld at the time, will the investor be in danger of being penalized for underpaying taxes at the end of the year? With a larger estimated tax payment at the end of the year, expose a client to penalties for underpayment of taxes in previous quarters when Roth conversions were done. This is a much more complex question, which I will try and give some broad advice to a pretty specific question. But why we recommend that you work with a CPA to figure out your quarterly tax estimates. First, there's no penalty if the taxes owed are under $1,000, or if you paid estimated taxes of at least 90% of the tax for the current year or 100% for the prior year, whichever one is smaller. Those numbers differ if you're over, I believe it's 150,000 of adjusted gross income. I think it goes to 110% for the prior year. The good news is the penalty isn't massive. It's about 3% of tax due, which Johann and I were talking this morning, which is you're likely going to do better in the market with that extra money than 3% in most years, at least. But if you do want to take a look at what to expect from a penalty standpoint, or if you want to look to see if you have to pay a penalty, the IRS form 2210 has a nice little flow chart that forms about underpayment of estimated taxes for individuals, trusts, and estates. And it's actually like pretty intuitive as far as government forms go. So worth taking a look at. That's form 2210.
Perfect. Thanks, Patrick. Yeah, so I'm looking at, we're getting a lot of questions. And I think, yeah, gosh, we're already pushing an hour. So I think what we'll do, any questions here, we'll just, we'll respond via email. I know we're trying to keep these webinars to an hour. Yeah, so we'll send all the questions here. We will send email responses to these. I think will probably be the easiest way to do it. But again, we just thank you again for coming along this webinar journey with us in 2020. We just really appreciate the support and the suggestions to try to make this experience more helpful for everyone. And we hope to continue doing some webinars like these in 2021, along with really hopefully some in-person events again. I'd love to be able to see some more people and get out in the community and do some more events. That's what we used to do. So we wish everyone and your families a happy Thanksgiving next week, and certainly feel free to reach out to us if there's ever anything that we can help with, or if you don't understand something. It's we really do like helping. So we hope to talk to everyone soon. Thank you so much.